Firms do not always behave in a way that benefits all economic agents, and governments may intervene to regulate the power these firms have. Market failure is a situation where the free market does not allocate resources efficiently, leading to a loss of economic welfare. Market power is the ability of a firm or group of firms to influence prices, output, or market conditions. A cartel is a group of firms that formally agree to coordinate prices, output, or market behavior to reduce competition. Cartels have some significance over market power as they enable firms to act collectively like a monopoly and raise prices above competitive levels. However, cartels may have little significance over market power as they are unstable and may collapse due to cheating or regulatory intervention. This may have an impact on market failure as reduced competition can lead to higher prices, lower output, and allocative inefficiency. Collusion is cooperation between firms, either formally or informally, to reduce competition and increase joint profits. Collusion has some significance over market power as it allows firms to coordinate behavior and exert greater control over prices. However, collusion may have little significance over market power as it is difficult to sustain where firms have incentives to undercut rivals. This may have an impact on market failure as coordinated behavior can distort price signals and misallocate resources. Restrictive practices are actions by firms that limit competition, such as price fixing, output restrictions, or exclusive agreements. Restrictive practices have some significance over market power as they strengthen firms' ability to control the market and deter entry. However, restrictive practices may have little significance over market power as competition law can limit or eliminate their effectiveness. This may have an impact on market failure as reduced competition can lead to inefficiency and consumer welfare loss. Tacit agreements are unwritten and unspoken understandings between firms to avoid competition without explicit communication. Tacit agreements have some significance over market power as they allow firms to maintain high prices without forming illegal contracts. However, tacit agreements may have little significance over market power as changing market conditions can break coordinated behavior. This may have an impact on market failure as sustained high prices can reduce consumer surplus and efficiency. Monopsony power is the ability of a single buyer to influence prices paid to suppliers or workers. Monopsony power has some significance over market power as it allows buyers to push prices or wages below competitive levels. However, monopsony power may have little significance over market power as supplier mobility and regulation can reduce buyer dominance. This may have an impact on market failure as underpayment can lead to inefficient allocation of resources. Natural monopolies are markets where high fixed costs mean one firm can supply the entire market at a lower average cost. Natural monopolies have some significance over market power as the dominant firm can exploit consumers through higher prices. However, natural monopolies may have little significance over market power as regulation can control prices and output. This may have an impact on market failure as regulation can reduce inefficiency while allowing economies of scale. Power in the labor market is the ability of employers or workers to influence wages and employment conditions. Power in the labor market has some significance over market power as dominant employers can suppress wages and working conditions. However, power in the labor market may have little significance over market power as trade unions and labor laws can counterbalance employer influence. This may have an impact on market failure as distorted wages can lead to inefficiency and inequality. The implications of market failure in the business world for economic agents are higher prices, reduced choice, inefficiency, and lower welfare. The implications of market failure in the business world for governments are the need for regulation, competition policy, and intervention to improve efficiency and equity. Business regulation is the use of rules and laws by governments or authorities to control business behavior and promote fair markets. Businesses can be regulated to promote competition, regulate natural monopolies, protect consumers, and protect employees. Business can be regulated by the Competition and Markets Authority and EU competition policy. Competition would be promoted because it encourages efficiency, innovation, lower prices, and greater choice for consumers. Competition could be promoted by preventing anti-competitive practices as firms are stopped from colluding or abusing dominant positions. This would help competition as markets remain open and fair for new and existing firms. Competition could be promoted by controlling mergers and takeovers as authorities can block or restrict deals that reduce competition. This would help competition as it prevents the creation of monopolies or overly dominant firms. Competition could be promoted through privatization as state-owned firms are exposed to market forces. This would help competition as private ownership can encourage efficiency and innovation. Businesses can be regulated to regulate natural monopolies as price caps and quality standards can be imposed. This would be done so consumers are protected from excessive prices and poor service. Businesses can be regulated to protect consumers as safety standards, product information rules, and consumer rights laws are enforced. This would be done so consumers are not exploited or misled. Businesses can be regulated to protect employees as laws on minimum wages, working hours, and health and safety are enforced. This would be done so workers are treated fairly and protected from exploitation. The Competition and Markets Authority has the role of promoting competition and preventing anti-competitive behavior. Businesses can be regulated by the Competition and Markets Authority as it investigates mergers, cartels, and abuse of dominance. This would be done so markets operate efficiently and in the public interest. Businesses can be regulated by EU competition policy as firms must comply with rules on state aid, cartels, and market dominance. The impact of EU competition policy is increased competition, consumer protection, and fair trading across member states. The benefits of regulation are increased competition, greater consumer protection, improved product quality, and reduced abuse of market power. However, the costs of regulation are higher compliance costs for firms, reduced incentives for innovation, increased bureaucracy, and the risk of regulatory capture. Thank you for watching this video on market power and market failure. I'll see you in the next one.